Sunil Subramaniam joins us. Sunil, good morning. Thank you for joining us, and a big thank you once again because you accommodated your calendar to join us today. It was a late-minute request, so thank you very much once again.
No, not an issue. Thank you. Can you hear me?
Okay, Sunil, I'll not get into mutual funds, redemptions. I'm not getting there, but I simply want to understand is that in this current market, if 12th of August is the starting point for somebody with a 3-year time horizon, what should be the expectations? Double-digit returns, volatile returns, or single-digit returns?
So if you can look at the asset allocation for a minute too. So with a 3-year outlook, I would call for a 50-30-20 large, mid, small. So with that understanding in mind, I think double-digit returns are definitely on the table. But your asset allocation must be this way. Because the way I see it is, so the next 18 months, large caps will continue to be the leader, right? Mid and small caps will begin their journey. See, the markets are showing something, but the earnings and honestly, the ground level economic recovery is not as strong as the initial V-shape. So let's be straight on the facts that there is liquidity which is drying up the market right now, both from FIIs as well as from retail investors directly buying equities. Mutual funds, as you know, have been net sellers since the beginning of the financial year. Context to that is why I'm saying this. So foreigners are essentially buying a long-term view of India and saying India is cheap. Okay, so that's their main reason for buying. Domestic retail investors are buying purely because they are at home and the upper middle class has got money on hand, and now technology and internet and stockbrokers. So especially if you see the kind of broker volumes going up, it's the low-cost brokers, Zerodhas, 5paisa.com, who have seen the maximum number of new customer things and the number of stocks rising. So this rally in small and mid cap is just a bounce back rally. I would give it a little bit of time for a sustainable rally in terms of the economy getting into real V-shaped recovery. So to me, 18-month plus, you will definitely see a much better return from mid and small caps. So for a 3-year outlook, right, I would say that 50-30-20 is the correct asset allocation now to do. And if you have a slightly longer, then I would argue for a 5-year, but you could actually up the mid and small cap by another 5% each and reduce your large cap down. So I think that's the right way to go about the thought process.
Sundaram, AMC, are you consciously looking at reducing your exposure to banks for whatever reason, under over ownership, benchmarking, maybe lack of clarity in the short term because of the economy? Are you looking at reducing that exposure?
Yes, absolutely. We are doing that, but I don't want to give a signal that I'm negative on the banks. But where I'm doing that is because the benchmark weights of the bank, whether it's a Nifty or the broader market, has come down because other sectors like IT, Pharma have kind of appreciated a lot. So that typically the weight in the benchmarks, and as fund managers, we have this daily report card to match with the benchmarks. I'm not bearish medium term on the banks. On the contrary, I am continue to be positive. But yes, we will have reduced our weights. We will reduce it because if the benchmark loses it, I don't want to get into a heavily overweight position on banks vis-a-vis the benchmark. But I'm not negative on the sector. I think that ultimately any V-shaped recovery which the market is discounting in some form has to be supported by the banks. And there could be a separation of the what do you call the men from the boys, right? The good quality banks with good capital adequacy will grab a larger share of the market. So I think that is the focus. So what I would reduce within a bank when I'm reducing is the weaker ones which don't seem to yet demonstrate a strategy, capital raising plans, and look at their NPA cycle in a very healthy manner. So there would be a polarization within banks. So when you ask me about banks overall reduction, but I would still say I would stick to my holdings on the larger, well-capitalized banks with access to international and domestic capital. So I think it has got to be a qualified answer from that perspective.
Sure. Is there merit, Sunil, you think, in going contra, buying aviation, buying multiplex stocks just yesterday? And we've seen some fund action come by. Interglobe Aviation just yesterday, Westbridge Capital has picked up about 1.4% stake. Today as well, the stock is holding out very well. Same is the case with the PVR, some of the travel tourism, hotel names as well holding out. Do you think time has come now to start nibbling into this space yet?
It depends on the risk appetite of the investor. So I think in direct equities, in portfolio management, and in alternate investment funds and special situation funds. So these four qualifications, I think people who are willing to take a short-term loss in the process can hold on, because ultimately there'll be winners and survivors. And even if you buy what was a wrong call, let's say in an aviation call, it will most likely be merged, in kind of a larger, and you will get some kind of a share swap into the larger company. So if you've got that risk appetite, so I would not recommend that mutual funds. I don't see that doing that unless there is a special situation fund going around. I don't think a mutual fund can afford the volatility that will continue as the news flow, and whether the government is going to recapitalize that segment, whether banks are going to give an extended moratorium for them or do some loan forgiveness. All of these are up in the air. So volatility is guaranteed. But that being said, if you ask me 5 years from now, will there be planes flying in there? Absolutely. Who will be flying those planes? Yes, you buy the sector, you will get the benefit. So for a high risk, a high reward person willing to take a significant proportion of losses, yes, today is a good price point to buy. But not for somebody who's looking to diversify and get a risk-reward ratio in their favor. So I think that mindset that you approach this is very critical. But if you do have that kind of a mindset, I don't think that they are penny stocks. So they are not like, I think they are good quality companies owned by good quality owners, right? But like I said, their sector is challenged. So any special situation, any turnaround kind of a strategy, I think this is a very good buy in that strategy. So I think if you have a clear view that I'm in a risky space, but I'm willing to take that call to a small proportion of your portfolio. So even the riskiest investor, right, in his overall portfolio allocation, it should still remain small. But yes, for that kind of an investor, it's worthwhile taking a bet, because no governments across the world can afford for the total sector to collapse, right? You need travel, end of the day. It might be reduced, but you need travel. You need people to get from place A to place B. And hence, overall, I think that with a sufficiently longer term time frame, with a sufficient quantitative share of being of a reasonable amount, and with a mindset which is willing to look at medium-term losses, but in the long-term gain, it's worth a look.
Sure. We were also just chatting about as to why is it some of the telecom names, and as limited as the listed universe may be, and keeping Jio outside, that seems to have just stalled. I mean, names like Bharti, for instance, and I don't want you to talk stock specific here, just an overall sectoral view. Irrespective of all the bullish calls on the street, the stock hasn't done anything. In fact, it's now cooled off all the way to those 530 odd levels. Do you think this entire AGR issue, Sunil, is turning out to be a big overhang, or is there more to it?
The AGR issue is definitely an overhang, and I think that's a key call that's there, number one. But like I said in an earlier interaction, I still believe that the Indian telecom market is large enough for a two-player and a 2.5-player, so to speak, industry to continue. I still think that the numbers in terms of their RPU and everything will go up. There will be relative market share thing, and everybody is hoping that I'm putting the winner takes all kind of a thought process. I don't share that. I think that ultimately the government, through its monopoly kind of a thing, will prevent a monopoly situation. You can't have that. Healthy competition, restrictive trade practices, all of those. Companies, I can't talk Indian companies, but overall, if you see Google, Microsoft, Apple, all are facing these kind of challenges at various courts in Europe and everywhere else on that. So I think that in India, right, government will act to permit a healthy industry, and a 2.5-player industry, as it looks at this point, is a fair enough thing. Now, the stock market discounting this based on AGR news, based on capital raising, based on all of that is there. But if you look at all these 2.5 players, I think there is sufficient foreign capital also behind these. Now, the largest player, without taking the name, is getting it in terms of equity stakes. But the other two have got significant foreign ownership. And they also, like I said, if FIIs and FDI is taking a longer term view of India, these owners will also take it. But at what price, where, there will be ifs and buts. So I would say that I still retain my fact that the marketplace is big enough for a 2.5 player industry, and all players should be able to benefit decently. The recent short market corrections and all, I mean, depending on where your price point of entry is, I think it's definitely worth looking at from whether you want to add to your portfolio in that particular stock without, in terms of, so simple to say that still maintain a diversified approach to the sector within the sector.
Okay. We haven't touched upon consumption post, the sharp, valuations that everyone talked about earlier on or a couple of months ago. But if we break it down a little bit and focus more on the auto or the discretionary right now, yesterday we also saw a whole host of those auto anch names, which is probably more a manufacturing play. I'm not sure. But, we're also now focusing on earnings and the rural revival. What are your thoughts, Sunil, on the way forward? Because they've been hit really hard, and while markets, of course, are looking ahead, it might be still a while before we really see a substantial pickup there.
Yeah, sure. So I would like to look at it as a two-part thing. One is a growth play and a value play. One. Second is that the consumption sector, I'd like to again differentiate it as a safety play and a risk play. So let me just explain. I've said a lot here. So to me, the overall consumption space has a safety play in FMCG, right? And there's a risky play in auto and in consumer discretionary or consumer durables. You can use either name, like ACs, refrigerators, and the like, right? So there's a safety element of FMCG, and there's a higher risk reward thing, which is a interest rate sensitive risk reward play. So interest rate views also play in the consumer discretionary plus auto space. Now coming to the other aspect, which I said about the fact that there is a growth story there and there's a valuation story. Now, if you then correlate these two, right, you look at the consumption safety play, right, the FMCG and broader lower end consumption, consumer discretionary durables, lower end ones, right, they have always had a decent valuation right through this period because FII flows being consistent. There has been money to buy. First quarter mutual funds are also buying Jan, Feb, March. So they've always been allocating to that safety element. So their valuations never fell great, right? And expectation was that the growth would also remain in a high single digit, low double digit with some amount of correction in a short term for the lockdown, but overall that they will be a stable play. So outlook wise, look at it that there is no valuation gap there. In fact, some of them are very reasonably and fairly valued. So they will continue to the extent that you want to have a safety component, you will stay invested in that sector. But it's not going to be your multi-bagger, it's not going to be your this, but it'll always be a part of your portfolio. Now you come to the riskier aspect of the play, which is the interest rate sensitives. And there, when you look at it, like two very different stories. Autos had a bad last year, and there was a severe correction last year. So the valuations have definitely corrected from the highs of, say, 3 years ago. Right? There's a easier valuations, much more comfortable, number one. Number two, because they actually had a bad year, right? The YOY numbers. Now you talked about the rural recovery. Yes, that's the single part of the economy which is showing auto registrations going up. So YOY, your actual numbers of sales, EBITDA, profits are going to look much better, number one. Number two, valuations also are supportive. So that's why you see the recent bounce back. Autos have led the pack in a way. And I think that rate sensitivity, everybody, so 90% of the people buy auto with a loan, right? In any kind of auto. So the lower interest rate story, which is playing out with the transmission story gradually increasing, is also supportive of the auto play in addition to the rural. And in the auto is a wide space. So you have two-wheelers, you have entry-level cars, you have higher-level cars, you have tractors in the rural area kind of play, and then you have construction vehicles and all of that. So that construction, commercial vehicles, is the one which is going to be a little bit of a laggard, because the slowdown, or the cyclical slowdown which started in the CV sector, will take some time to play out. So within auto also, you got to have a segmented approach, and where. So I see two-wheelers, entry level, and tractors as the three. With the monsoon season coming up and with the festival season coming up, I see good YOY growth in sales. There is enough valuation gap. So I see that's a good sector which will grow. Now, leaving the last piece of the thing back, which is the consumer durable sector. Now, there what happened was that in the last year, though the numbers were not great, their valuations didn't correct as much, for the simple reason that the summer season is that peak season. So nobody anticipated, even when the crisis came, coronavirus first came, lockdown came, everybody thought that it will all end by the summer and the summer. That's been the disappointment, because there has been lockdown right through the summer and those numbers have got hurt. And segments of those which are definitely heat sensitive. Why I'm saying this, refrigerators, air conditioners, coolers are all bought in the summer. So you're unlikely to see a huge pickup in the coming monsoon, wintry season. Yeah, I mean, we don't have such a big heater market in India or whatever. So consumer durables is going to now not get a great YOY number pickup, but probably sometime during the course of the next 3 months, it'll start discounting the next summer. And next summer will be a big bang, because one, this summer was so bad. So YOY, your actual sales EBITDA, EPS numbers are going to look great. And hopefully by next summer, the Indian economy will be back on track with some kind of vaccine, cure, all of this in place. So there again is a good space to play, because there is a rate sensitive component to it in terms of that. The one final part which I had not covered in this is the auto ancillary pack. Now the auto ancillary will ride off the auto, but they also are a big export play. They are also a big Make in India play. And so part of the auto thing, right, will also auto ancillary piece. You've got to keep a watch out for how this whole Make in India play is playing out in terms of what is done. Right. I think that summarizes my view.
Yeah, 2 questions. All right. And very extensively, Sunil, great. Thank you so much. That really covered everything. We're going to leave it there this morning. Great chatting with you as always.